So if you've been investing for a long time or you watched my previous video, you're probably familiar with dollar cost averaging, buying the dip, or lump sum investing. But today we're going to be talking about which one might be the most effective strategy, and we're going to look at a lot of data points that back up this thesis. So before I get started, make sure to smash the like button if you haven't already. And if it's your first time to the channel, please do me a favor and subscribe. And also it helps you out because then you get more valuable content like this. So let's dive into today's episode. So we have here lump sum versus dollar cost averaging. When investing a new sum of money for 20 years, immediately dumping it in all at once in a lump sum has outperformed dollar cost averaging 71% of the time. Now, lump sum over here on the left, easy pie graph for you, and then dollar cost averaging on the right. This is obviously talking about index investing, which is investing in something like the S&P 500 index, for example, but that doesn't mean that certain situations, dollar cost averaging works better. As you can see, 29% of the time, dollar cost averaging does seem to work better. Obviously, you can't really predict this, but seemingly you have better odds with lump sum in this example. And with this pie chart, you might think, okay, lump sum investing is the way to go. But what happens if you put all of your life savings into some investments and this huge drop happens, right? Just like this graph on the screen here. What if this huge drop happens and you lose all your money? And I'm not saying it's gonna go to zero like this, but just imagine this going from like $50 to $1. Well, that's when economists are going to tell you you should have dollar cost averaged in. And if you're wondering what dollar cost averaging actually means, let's talk about that first. So dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested, let's say $10,000, across periodic purchases of a target asset or assets in an effort to reduce the impact of volatility on the overall purchase. The purchases typically occur regardless of the asset's price and at regular intervals, meaning it could be once a week, once a month, once every quarter, or maybe even just when you get paid. In effect, this strategy removes much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. Essentially, dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed with regard to asset pricing. You don't want to buy GameStop at the peak, just like you don't want to buy Dogecoin at its peak either. And dollar cost averaging into those assets would actually help you average out your investment and not only decrease the risk of the investment, but also increase the upside. And if you watched my previous video, you might remember this slide that we're gonna see next. And this is dollar cost averaging versus buying the dip, because buying the dip is something that a lot of people say, hey, why don't you just buy the dip? Just buy it. Just buy the dip. It will go back up. You'll be fine. You'll actually make more money than dollar cost averaging because you're buying everything on a discount. Well, this is where things take a little bit of a turn. As you can tell from this graph, you actually don't make as much money buying the dip as just simply dollar cost averaging in. The amount invested during this time is the exact same, but the outcomes are much different. In fact, almost around $50,000 different. And so when you think about it this way, well, now dollar cost averaging seems at least to be better than buying the dip. So seemingly, we've kind of built a hierarchy of buying in lump sum, dollar cost averaging, and then buying the dip. Even though a lot of people online will tell you, well, you should buy the dip, you should dollar cost average, and you should avoid lump sum investing. Kind of interesting, right? So at the end of the day, should you buy the dip, dollar cost average, or buy a lump sum? Obviously, from the data we've talked about already, lump sum is technically king as far as returns, but has the most risk. Then dollar cost averaging has the lowest risk and probably similar results to lump sum investing, slightly different. And buying the dips is probably the least effective strategy of all. But when you consider dollar cost averaging to mitigate the risk and have pretty decent gains, you can also add along the way when the market does happen to dip, and that seems to be maybe the best strategy of all. Now, if you started investing in 1986, investing a lump sum into the S&P 500 would have paid off the most versus the other two strategies, as you can see here. But what about in 2000? Well, your returns would look much different from the previous strategy. In fact, lump sum would now be the worst performing strategy. And how about now? Well, now, if you were starting during the 2008-2009 collapse, well, then lump sum wins by magnitudes once again. So what does the data really show? At the bottom of an economic collapse, lump sum works the absolute best, right? This is just a no-brainer. In a downtrending market, dollar cost averaging mixed with buying the dips works better. And at the top of the market, dollar cost averaging works the best since it has the most protection for your dollar in case a downturn is about to start. But at the end of the day, it is up to you. And remember what they say about trying to time the market? Remember that time in the market beats trying to time the market. And as simple as that might sound, that strategy is extremely effective. Just dollar cost average in, buy the dips when you can, and try to make it fun, because investing really shouldn't be a headache. If it is, maybe that's just not the hobby that you want to partake in, and you can just buy index funds and quit trying to pick stocks. Thank you all so much for watching and making it all the way through this video. If you don't mind, smash the like button, and if you haven't already, smash the subscribe button as well. That's all for today's episode. I hope you learned a ton. If you want to leave me something down in the comment section below, you're more than welcome to do so. And if there's anything that you'd like to see in a future episode, leave it down there as well. And finally, there are a lot of links down in the description below to companies like Robinhood, Stash, M1 Finance, Public, WeBull. All of these links will literally give you free money just for trying out their platform, and a combined total, as of making this video, the promotion right now for all of these is worth almost $10,000.
Wow.
So go check those out if you haven't already, and I'll see you guys in the next episode. Peace out.